This call, Komal Sri, I should say, making you highly unpopular on Wall Street, recommending the Fed raise rates not by 50, 75, or 100 basis points, but 125. Tell us why.
Seema, I'm trading short-term unpopularity for long-term popularity. That would be the best way to put it. Yes, it is difficult for the markets if the rates rise by 1.25 percentage points. But if the Fed actually does that, they are going to be ahead of the market for the first time rather than be a simple follower, which the Fed should not be. So Jerome Powell has repeatedly said inflation is going to be transitory. Even when he changed his mind, it took several more months before the tightening to begin. So the Fed credibility is still very low, Seema. What I'm saying is doing 1.25 percentage points is going to do a lot in terms of helping credibility, and that is very good for markets, both equities and fixed income over the medium term.
Sri, beyond the Fed's 2% target, how much weakness in the labor market is the Fed willing to tolerate? We've already seen unemployment rise from 3.5 to 3.7%. How high will they allow it to go? 4.5%? What are you expecting?
I think 4.5% is fine in terms of acceptability for the Fed, Seema, given that the midterm elections are taking place this November and we don't have the presidential elections for another 2 years. So the political side of it is going to be relatively dormant, so you can tolerate a higher unemployment rate in the short term. Here is the problem. And Brian spoke earlier in the program about possible credit events. If you have a major institution that is about to fail, as we saw in 1998, 2008, then typically the Fed springs into action, gives up all of its anti-inflationary message, and switches over to flooding the market with liquidity and bailing institutions out. That, to me, is the risk, Seema, not a higher unemployment rate.
Hey, Sri, thank you very much for the shout out. Do you think there is a risk of a credit event? I mean, Scott Miner, the previous hour, talked about commercial mortgage-backed securities, not as big as residential. We get that. It's not 07. It's not 08. Nobody's saying that. But the reality of it is, if you got a bunch of half-filled skyscrapers in San Francisco and L.A. and Portland and New York and Chicago and a couple $100 billion in debt on them, that is not a small thing.
It is not a small thing at all. And what we don't know, Brian, is to what extent those events, even if they are not a 1998, even if it's not a 2007, what if they cascade one on top of the other and you have 2 or 3 institutions which get hit with a domino effect? That's something we do not know. I don't think the Fed is aware of it as well either. And if that happens, that's when all the bets are complete. You need to change your playbook right away if that happens, because the Fed is not going to stick with its anti-inflationary stance anymore. That's the problem with what I have with the Fed today. It is easy to keep citing Paul Volcker at every press conference. It's a lot more difficult to behave like Paul Volcker. Again, during the beginning stages of my career, I watched the tractors rush over to Washington, D.C. to surround the Federal Reserve building because the interest rates were so high. There were construction people who were shipping bricks over to the Federal Reserve because there was no construction industry. There is no way this chairman, this Federal Reserve, is going to go to any of those lengths to control inflation. And with having let inflation go to such a high level, Brian, they have to do a lot more than what they have done so far.